51st meeting of the Monetary Policy Committee, that is the MPC, and this is how it goes. The flexible inflation targeting framework has completed 8 years since its introduction in 2016. This is a major structural reforms of 21st century India. It stands out for its committee approach to decision making, transparency of policy making process and communication, accountability hinging upon quantitatively defined inflation target, and operational independence. Over the years, the framework has matured across various interest rate cycles and monetary policy stances. When I look back, I can say with confidence that the flexible inflation targeting has served us well over the years and has proved its mettle. It brought about an era of price stability in the pre-COVID-19 period, with inflation averaging around the target rate of 4%. Thereafter, despite continuing global turmoil from multiple sources in the last 4 years or so, the flexibility embedded in the flexible inflation targeting framework has helped us to effectively address these unprecedented challenges while supporting growth. Monetary policy in India was able to respond to the economic slowdown decisively and swiftly in the wake of the COVID-19 pandemic, and again preemptively during the buildup of inflationary pressures after the war began in Ukraine in early 2022. The prevailing well-balanced growth inflation dynamics is indeed a testimony to the success of this monetary policy framework. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on, and this time, as you would be aware, this time we have 3 new external members in the MPC. The Monetary Policy Committee with 3 new external members met on 7th, 8th and 9th October. And after assessing the evolving macroeconomic and financial conditions and the outlook, the MPC decided by a majority of 5 out of 6 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate and the bank rate, they stand at 6.75%. Further, the MPC decided unanimously to change the stance, that is the stance of the monetary policy, to neutral, and also decided to, let me read it again, the MPC decided unanimously to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC noted that currently the macroeconomic parameters of inflation and growth are well balanced. Headline inflation is on a downward trajectory, though its pace has been slow and uneven. Going forward, the moderation in headline inflation is expected to reverse in September and likely to remain elevated in the near term due to adverse base effects among other factors. Food inflation pressures could see some easing later in the financial year on the back of strong kharif sowing, adequate buffer stocks and good soil moisture conditions which are conducive for rabi sowing. Adverse weather events continue to pose contingent risks to food inflation. Core inflation, on the other hand, appears to have bottomed out. Fuel component of the CPI remains in contraction. Domestic growth has sustained its momentum with private consumption and investment growing in tandem. Resilient growth gives us the space to focus on inflation so as to enable its durable descent to the 4% target. In these circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain, I repeat, and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above normal southwest monsoon rainfall and better kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal, and cement in August. The Purchasing Managers Index, that is PMI for manufacturing, at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion. On the demand side, rural demand is trending upwards while urban demand continues to hold firm. Government consumption is improving. Investment activity remains buoyant with government capex rebounding from a contraction observed in the first quarter of this year. Private investment also continues to gain steam on the back of expansion in non-food bank credit, higher capacity utilization, and rising investment intentions. On the external front, services exports is supporting overall growth. Looking ahead, India's growth story remains intact as its fundamental drivers, namely consumption and investment demand, are gaining momentum. Prospects of private consumption, the mainstay of aggregate demand, look bright on the back of improved agricultural outlook and rural demand. Sustained buoyancy in services would also support urban demand. Government expenditure of the center and the states is expected to pick up pace in line with the budget estimates. Investment activity would benefit from consumer and business optimism, government's continued thrust on capex, and healthy balance sheets of banks and corporates. Taking all these factors into consideration, real GDP growth for 24-25 is projected at 7.2%, with Q2 at 7%, Q3 at 7.4%, and Q4 7.4%. Real GDP growth for Q1 of next financial year, that is 25-26, is projected at 7.3%. The risks are evenly balanced. I would now like to turn to inflation. Now, as anticipated, headline inflation softened significantly in July and August, with base effect playing a major role in the month of July. Food inflation experienced a certain degree of correction during these 2 months. Considerable divergence, however, was observed within the food subgroups. Now, whatever I am saying, I have given a lot of data in the footnote of my statement, which as usual will be uploaded in the RBI website immediately after my statement is, immediately after I complete my statement. For example, I just now said that considerable divergence, however, was observed within the food subgroups. So this is backed up by the data which I have given in the footnotes. And in fact, all the statements that I am making are backed up by supportive data there in the footnotes. So those of you who are interested may like to have a look at them after it is uploaded. Now, deflation in fuel group deepened on softening electricity and LPG prices. Core inflation, on the other hand, edged up in July and August. The CPI print for the month of September is expected to see a big jump due to unfavorable base effects and pick up in food price momentum. And this would be caused by the lingering effects of a shortfall in production of onion, potato and chana dal, that is gram, in 2023-24, among other factors. The headline inflation trajectory, however, is projected to sequentially moderate in Q4 of the current financial year due to good kharif harvest, ample buffer stocks of cereals, and a likely good crop in the ensuing rabi season. Unexpected weather events and worsening geopolitical conflicts continue as major upside risks to inflation. International crude prices have become volatile in the month of October, that is in the current month. The recent uptick in food and metal prices, and this is very important, the recent uptick in food and metal prices as seen in the FAO, that is Food and Agricultural Organization, and the World Bank price indices for September, if sustained, can add to the upside risks to CPI inflation. Taking into account all these factors, CPI inflation for 2024-25, that is for the current year, is projected at 4.5%, with Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%. CPI inflation for the first quarter, that is Q1 of next financial year, that is 2025-26, is projected at 4.3%. The risks are evenly balanced. Now, I have summarized our assessment of the domestic growth and the inflation conditions and the outlook as per our assessment. Now, what do this raises the question, what do these inflation and growth conditions mean for monetary policy? The developments since the last meeting of MPC in August indicate further progress towards realizing a durable disinflation towards the target. Despite the near-term upsides to inflation from food prices, the evolving domestic price situation signals moderation in headline inflation thereafter. The agricultural crop outlook is turning out to be favorable with improving prospects of kharif and rabi output. These factors could lead to an easing of food inflation pressures, but this optimism is subject to weather-related shocks, if any. Core inflation is likely to remain broadly contained on continuing transmission of past monetary policy actions, unless, of course, there are surprises in global commodity prices. The prevailing and expected inflation growth balance, please mark my words, the prevailing and the expected inflation growth balance have created congenial conditions for a change in monetary policy stance to neutral. Even as there is greater confidence in navigating the last mile of disinflation, significant risks, I repeat, significant risks to inflation from adverse weather events, accentuating geopolitical conflicts, and the very recent increase in certain commodity prices continue to stare at us. The adverse impact of these risks cannot be undermined, cannot be underestimated. It's with a lot of effort that the inflation horse has been brought to the stable, that is closer to the target within the tolerance band compared to its highest or heightened levels 2 years ago. We have to be very careful about opening the gate, as the horse may simply bolt again. We must keep the horse in tight leash so that we do not lose control. Going forward, we need to closely monitor the evolving conditions for further confirmation of the disinflationary impulses. I would now like to turn to the liquidity and financial market conditions. System liquidity remained in surplus during August and September and also in early October, with a pickup in government spending and decline in currency in circulation. Liquidity conditions, however, had turned into deficit for a brief period during the latter half of September, with the buildup of government cash balances on account of tax-related outflows. In sync with the shifting liquidity conditions, the Reserve Bank proactively conducted two-way operations to ensure alignment of interbank overnight rate with the policy repo rate. Across the term money market segments, the yields on 3-month treasury bills, that is T-bills, and commercial papers issued by non-banking financial companies, that is NBFCs, eased, while that on certificates of deposits firmed up marginally. The 10-year G-Sec yield softened in August-September on global and domestic cues, including policy pivot in the United States and also in some major economies. And also, these are not the only factors, but the yields in August-September, I am talking about the 10-year G-Sec yields, they softened somewhat in August and September due to multiple factors, which would include pivot in the monetary policy of the US and some major economies, improved global investor sentiment, benign domestic inflation, and accelerated fiscal consolidation. The term premium, that is 10-year G-Sec yield minus 3-month T-bills yield, has remained stable in the recent few months. Transmission to the credit market has been satisfactory. Moving forward, the Reserve Bank will continue to be nimble and flexible in its liquidity management operations. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner. During the current financial year, that is up to 8th of October, that is till yesterday, the exchange rate of the Indian rupee has remained largely range bound. The Indian rupee also continued to be the least volatile among peer EME currencies. This was so even during the high volatile episode following the unwinding of the yen carry trade in early August this year. The lower volatility of the Indian rupee reflects India's strong macroeconomic fundamentals and improved external sector outlook. I would now turn to financial stability. The health parameters of banks and NBFCs in India continue to be strong. There has been some recent commentary on the likelihood of stress build-up in a few unsecured loan segments like loans for consumption purposes, microfinance loans, and credit card outstandings. The Reserve Bank is closely monitoring the incoming information and will take measures as may be considered necessary. Banks and NBFCs on their part need to carefully assess their individual exposures in these areas, both in terms of size and quality. Their underwriting standards and post-sanction monitoring have to be robust. Continued attention also needs to be given to potential risks from inoperative deposit accounts, cybersecurity landscape, mule accounts, and a few other factors which we have been stressing and highlighting time and again in the public domain as well as in our interaction with the banks and NBFCs. Now, overall, I would again like to stress that our banking and the NBFC sector, that is the financial sector, remains healthy, resilient, and stable. NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks, which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. These practices are sometimes further accentuated by what appears to be a push effect as business targets drive retail credit growth rather than its actual demand. I am not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening bilaterally, we are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay and incentive structures, some of which appear to be purely target driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs including MFIs and housing finance companies follow sustainable business goals, a compliance first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option. Coming to external sector, India's current account deficit, that is CAD, widened to 1.1% of GDP in the first quarter of this financial year, that is 24-25, and this was on account of higher trade deficit. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within the sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, have seen a turnaround from the net outflows of $4.2 billion in April and May this year. They have turned from net outflows. In April and May, we had net outflow of $4.2 billion. Now they have now turned to net inflows of $19.2 billion during June to October, and this is the figure till 7th of October. Foreign direct investment, that is FDI flows, remain strong in 24-25 as both gross and net FDI flows have improved in April and July. While external commercial borrowings moderated, non-resident deposits recorded higher net inflows compared to last year. India's foreign exchange reserves have already crossed a new milestone of $700 billion. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. And when I say key external sector vulnerabilities continue to improve, I have backed it up by the data in the footnote of the statement. On the whole, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first relates to responsible lending conduct, levy of foreclosure charges and or prepayment penalties on loans. The Reserve Bank has taken several measures over the years to safeguard consumer interest. As part of these measures, banks and NBFCs are not permitted to levy foreclosure charges or prepayment penalties on any floating rate term loan sanctioned to individual borrowers for non-business purposes. That is, for purposes other than business. It is now proposed to broaden the scope of these guidelines to include loans to micro and small enterprises, that is MSEs. A draft circular in this regard shall be issued for public consultation. The second announcement relates to discussion paper on capital raising avenues for primary urban cooperative banks, that is for UCBs. The Reserve Bank has undertaken several initiatives in recent years to strengthen the UCB sector. Such initiatives include issuance of regulatory guidelines in 2022 for issue and regulation of share capital and securities by the urban cooperative banks. To provide more flexibility and avenues to the UCBs, that is urban cooperative banks, to raise capital, a discussion paper on capital raising avenues for UCBs will be issued for feedback and suggestions from stakeholders. The third announcement relates to creation of Reserve Bank Climate Risk Information System. Climate change is emerging as a significant risk to financial system world over. This makes it necessary for regulated entities to undertake robust climate risk assessment, which is sometimes hindered by gaps in high quality climate related data. To bridge these data gaps, the Reserve Bank proposes to create a data repository, namely the Reserve Bank Climate Risk Information System, or in short RBCRIS, Reserve Bank Climate Risk Information System, that is RBCRIS. The next announcement relates to UPI, where we are enhancing certain limits for the various transactions. UPI has transformed India's financial landscape by making digital payments accessible and inclusive through continuous innovation and adaptation. To further encourage wider adoption of UPI and make it more inclusive, it has been decided first to enhance the per transaction limit. To enhance the per transaction limit, in UPI 123 Pay from rupees 5,000 to rupees 10,000. And second, it has also been decided to increase the UPI Lite wallet limit from rupees 2,000 to rupees 5,000 and per transaction limit from rupees 500 to rupees 100. The final announcement relates to introduction of beneficiary account name lookup facility. Let me explain what it means. At present, UPI and Immediate Payment Service, that is IMPS, provide a facility for the remitter of funds to verify the name of the receiver of the funds, that is the beneficiary, before executing a payment transaction. It is now proposed to introduce such a facility for RTGS as well as the NEFT systems. This facility will enable the remitter to verify the name of the account holder before effecting funds transfer to him or her through RTGS or NEFT. This facility will also have the effect of reducing the possibility of wrong credits and frauds. Let me now conclude. Today, the Indian economy presents a picture of stability and strength. The balance between inflation and growth is well poised. India's growth story remains intact. Inflation is on a declining path, although we still have a distance to cover. The external sector demonstrates the strength of the economy. Forex reserves are scaling new peaks. Fiscal consolidation is underway. The financial sector remains sound and resilient. Global investor optimism in India's prospects is perhaps at its highest ever. We are, however, not complacent. I repeat, we are not complacent, especially amidst the rapidly evolving global conditions. The monetary policy action today reflects the MPC's assessment that at the current juncture, it would be appropriate to have greater flexibility and optionality to act in sync with the evolving conditions and the outlook. We stand unambiguously committed to ensure durable alignment of inflation with the target while supporting growth. In the prevailing macroeconomic conditions and the outlook, Mahatma Gandhi's words remain highly relevant, and I quote, "When the method is good, success is bound to come in the end." Thank you. Namaskar. Flexible inflation targeting framework has completed 8 years since its introduction in 2016. This is a major structural reforms of 21st century India. It stands out for its committee approach to decision making, transparency of policy making process and communication, accountability hinging upon quantitatively defined inflation target, and operational independence. Over the years, the framework has matured across various interest rate cycles and monetary policy stances. When I look back, I can say with confidence that the flexible inflation targeting has served us well over the years and has proved its mettle. It brought about an era of price stability in the pre-COVID-19 period, with inflation averaging around the target rate of 4%. Thereafter, despite continuing global turmoil from multiple sources in the last 4 years or so, the flexibility embedded in the flexible inflation targeting framework has helped us to effectively address these unprecedented challenges while supporting growth. Monetary policy in India was able to respond to the economic slowdown decisively and swiftly in the wake of the COVID-19 pandemic, and again preemptively during the buildup of inflationary pressures after the war began in Ukraine in early 2022. The prevailing well-balanced growth inflation dynamics is indeed a testimony to the success of this monetary policy framework. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on, and this time, as you would be aware, this time we have 3 new external members in the MPC. The Monetary Policy Committee with 3 new external members met on 7th, 8th and 9th October. And after assessing the evolving macroeconomic and financial conditions and the outlook, the MPC decided by a majority of 5 out of 6 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate and the bank rate, they stand at 6.75%. Further, the MPC decided unanimously to change the stance, that is the stance of the monetary policy, to neutral, and also decided to, let me read it again, the MPC decided unanimously to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC noted that currently the macroeconomic parameters of inflation and growth are well balanced. Headline inflation is on a downward trajectory, though its pace has been slow and uneven. Going forward, the moderation in headline inflation is expected to reverse in September and likely to remain elevated in the near term due to adverse base effects, among other factors. Food inflation pressures could see some easing later in the financial year on the back of strong Kharif sowing, adequate buffers. Yeah, I think where are the photographers? They have taken? Already done? But I was looking down. It's okay. Thank you.
Sir, so we may start, sir?
Are there less number of people today? Or is the
24, sir, same number.
Maybe it's a bigger hall, that's why it looks different.
We are ready to get 2 people if you are allowed.
No, maybe in future, if we are doing it here, we could consider that. But please go ahead.
Sir, thank you, sir. So hello and good afternoon. Welcome to this post-monetary policy press conference in this new setting. Friends, we have with us Governor Reserve Bank of India, Shri Shaktikanta Das, Deputy Governors, Dr. M.D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Director, Shri Dr. Rajiv Ranjan, and other colleagues from Reserve Bank. To begin with, I would request Governor Sir to make his opening remarks. After that, we will have the question answer session. Sir, please.
Thank you, Puneet, and good morning and welcome to all of you. As I already said, season's greetings to each one of you. These are main highlights in my monetary policy statement. I am not going to say anything new, drawn from the MPC. So I would like to make about totally 9 points, and I'll be quick. First, India's growth story remains intact. Second, inflation is on a declining path, although we still have a distance to cover. There are significant risks to the inflation outlook, and these risks cannot be underestimated. We need to remain vigilant. Number 3, the balance between inflation and growth is well poised. Number 4, the external sector remains stable and reflects the strength of the Indian economy. 5, forex reserves are scaling new peaks. Resilient. 7, the Reserve Bank will continue to be nimble and flexible in liquidity management operations. 8, today's monetary policy action gives greater flexibility and optionality to the MPC to act in sync with the evolving conditions and the outlook. I'd like to repeat this. Today's monetary policy action gives greater flexibility and optionality to the MPC to act in sync with the evolving conditions and the outlook. 9, we are acutely aware that there is no room for complacency, especially amidst the rapidly evolving global conditions which encompass geopolitics, financial markets, and commodity prices. Thank you.
Thank you, sir. Before we begin, I will request our media friends present here to please wait for your turn. You may see my colleagues on both sides of the aisle with mics in their hand. So, as I call out your name, they will hand over the mic to you. In the interest of time, humble request, please restrict to one question per person. And if time permits, we may consider some other questions. Sir, as mentioned, sir, there are 24 participants from media today. And with your kind permission, I'll call out the names. So I'll start with Ms. Lata Venkatesh from CNBC.
Lata Venkatesh from CNBC. Thank you very much for the opportunity. Thank you, Governor. Even if you cut, do you think, as and when you cut, do you think the fact that deposit rates are, acutely being fought for and are high, do you think it will get percolated at all, and therefore, or transmitted at all? And therefore, what is your assessment of when deposit rates may peak off? Have they peaked off?
You see, the interest rates or the policy repo rate, the decision of the MPC will be determined by the growth inflation dynamics. And we have been saying that repeatedly. Depending on the overall inflation outlook and the growth outlook, as mandated under the monetary policy, the interest rates the MPC will decide with regard to the policy repo rate. Now, the lending rates, the deposit rates, and other money market rates naturally will move in tandem or in response to the interest, to the policy repo rate decided by the MPC. MPC, of course, takes into account multiple factors. Financial stability aspects and other aspects are taken into account. While primacy is given to inflation outlook and growth, MPC does take into account several other factors. But money market rates, including deposit rates or credit rates, they respond to the policy. And all factors are kept in mind by the MPC before taking decisions. No, I can't say whether interest rates or the, the deposit rates, the credit rates or the deposit rates are peaked. It's for the lenders, the banks and NBFCs to decide. These are commercial decisions in response to the, overall economic conditions.
Thank you, sir. We'll have Mr. Manojit Saha from Business Standard.
Good afternoon, sir. Now you have changed the stance to neutral, while you have said that the moderation in headline inflation is expected to reverse in September and going to stay elevated. So the elephant has not really come back. He is still around. He's still in the forest. So why the change in stance to neutral when inflation is expected to stay elevated?
I think you missed the shift from elephant to the horse. The horse, with lot of effort, the horse has been brought into the stable. We cannot, we have to be very careful before opening the gate of the stable, because there is every chance that the inflation horse will simply bolt again. We have to hold it in tight leash and have greater confidence and alignment of the inflation with the target. But specifically, what was your question?
Why the change in stance at a point when inflation is expected to stay elevated?
No, you see the near-term outlook. If you see the statement, if you read the statement carefully, what we have said in the statement is that September it is going to be high. The data will be released on Monday. October also it is expected to remain high, maybe around 5% or so, and mainly on base effect factors as well as uptick in certain components of food inflation. So in the near term the inflation is remaining high, but thereafter there is moderation going into the third quarter. And also we have given the number for the for the third, fourth, and also for the first quarter of next year. So we have now greater confidence that inflation is moderating, but we are acutely aware that there are significant risks. I have made a reference to the data released just about a week ago by the FAO and the World Bank with regard to the commodity prices, including food also. We have to be very careful. So therefore, we have changed the stance at the moment because we see that growth and inflation, they are well poised. The balance is well poised. So the MPC considered it appropriate. The timing is appropriate to shift the stance to neutral.
So it's a pivot.
No, that is for you to assess whether it's a pivot. And neutral stance, as I said in the statement, it gives us optionality and flexibility to take decisions.
Thank you, sir. We'll have Mr. Anup Roy from Bloomberg.
Thank you, sir. Governor, you changed the stance and you gave a very strong statement that inflation, you are seeing some durable signs of inflation moderating towards the target. Given that you prefer clear communication and transparency, is that a very strong signal for a rate cut or pivot in December policy or even before that out of policy?
I think I'll request Deputy Governor Michael Patra to take that question.
So you should just assess the stance by itself, independently. So we will, as Governor mentioned, we will like to see off the near-term hump in inflation, which we all our projections suggest is going to happen. We want to see it off carefully before even considering the next move. So our whole attention is now focused on this near-term hump.
Thank you, sirs. Next, we'll have Ms. Swati Bhatt from Reuters.
Thank you so much, sir. So I just wanted to understand, India is now included in all the three emerging markets.
Just keep it a little closer.
Okay, is this better?
Yeah.
Governor, I just wanted to understand, so now India has been included in the FTSE Russell index as well. We already were included in the JP Morgan and Bloomberg index. To what level are we comfortable in terms of these foreigners owning government bonds? Is there a comfort level that the RBI has? If you can just briefly explain that. Thank you.
I think you can reply.
So the current holding of government bonds by foreigners is just about 3%. So even the question of what is a sustainable level doesn't rise. Even under the various routes, it's very, very low. For instance, under the FAR is just about 5.5%. So we will wait for these numbers to get to a decent level before we take a view.
Thank you, sirs. Next, we'll have Mr. Ashish Akashe from PTI.
So why have you retained the growth target at 7.2%, and what you are estimating that the second half there would be an acceleration in growth? Why are you expecting that to happen?
So I think I have explained it in my statement. I mean, the drivers of growth, the critical drivers of growth, that is consumption and investment, they continue to be quite stable. Private consumption, we saw in the first quarter data, was far better. And investment also, the numbers are looking good, and private investment is showing signs of pickup. In fact, going by the investment intentions of the corporates, given their deleveraged balance sheets, the government capex, going by all signs, I think private capex as well as the government capital expenditure is also doing well, and the services, services sector is also continuing to do well. And further, agriculture is going to provide a big boost this time, not only on the supply side, but also to consumption demand in the rural sector. The monsoon southwest has been very good. Expectations of a good, the expectations of a good rabi output are also fairly strong thanks to high reservoir levels and the moisture conditions of the soil. So rural demand is expected to maintain its momentum. Urban demand remains steady and will get support from buoyant services sector. So if you put all these things together, I think it gives us, the number that we get is 7.2%. And as I have already articulated, the first quarter numbers should not be, which came at 6.7%. It was primarily due to lower expenditure by both central and state governments. Maybe because of it coincided with the election season. In fact, but we now get a sense that both state and central government expenditures will meet their budget figures, will meet their budget estimates. An important aspect also which has been perhaps missed out, but which was highlighted in the State of Economy Bulletin article of which was released in September, in the last month's bulletin article. Now, if you sort of the first quarter, the subsidy payout was very high by the state governments in particular, and also to some extent by the central government. So GDP is basically GVA plus subsidies, plus indirect taxes minus subsidies. That is plus indirect taxes minus subsidies. Subsidies were very high. In fact, if you take out the effect of the subsidies, the GDP growth would have been quite above 7%. I do have the number, but I don't want that to be a headline. The actual GDP growth would have been upwards of 7%. But that is a statistical aspect. We don't go by statistical factors. We go by real economic activity at the ground level. And I have just explained why we are sticking to 7.2%. We just have the first quarter data. Second quarter data will come only in the end November. Second half of the year is just beginning. And our sense is that the growth is maintaining its momentum. So that's why we are sticking to 7.2%.
Thank you, sir. I would now ask Ms. Sangeeta Mehta from Economic Times.
Thank you, Governor. So, the feedback that we get in our conversations speaking with NBFCs is that the credit to GDP ratio in India is still very low. So, in that context, the observation that RBI has made that there is a push effect rather than the actual growth. How do you arrive at this? I mean, is it because that there is a huge, substantial rise in NPA? Or is it that there are some other findings that RBI has?
You see, the push effect is confined to certain NBFCs. I am not generalizing for the whole NBFC sector. I said it also very clearly that the overall NBFC sector is doing, is maintaining good, remains stable and has good health. But more specifically, I would request DG Swaminathan to reply to that question.
Yeah, thank you, sir. So as Governor said, this particular messaging was for a set of players on the one hand, on the other hand to certain select segments in which we see an outlier growth. And these segments were called out earlier as well in our last year's prudential action. And the commentary that you would see from the June data as well as July-August numbers, September numbers are still awaited, is that there are certain elevated slippages and little higher credit cost being seen in select segments. So the messaging is targeted towards such of those NBFCs which are pursuing a high risk, high growth strategy, and also to certain segments which are likely to get into stress in our estimate. So it's not a generalized message, so it has to be seen in that context.
Higher risk weights will come.
No, you have to wait. You have to wait for that.
Again, you have to read the governor's statement. The last line very clearly says we are watching the incoming information and then take measures as may be appropriate.
These are certain segments within NBFCs?
It's again contained in the statement itself. The 3 segments have been already mentioned in the statement.
Thank you, sirs. I'd request to please speak in the mic, because here, if you don't speak in the mic, people won't get it outside. Next is Ms. Hamsini Karthak from Money Control.
Thank you, Governor.
Mic closer, yeah.
Thank you, Governor. My question is actually a continuation on the NBFC side, more specifically to microfinance loans. Microfinance as a pocket is getting considered as a 7 to 9% credit loss kind of a sector. And most of the players in the industry believe that that can be priced in. The risk can be priced into the interest rates as well, which is having somewhere a counterproductive effect on the rate of interest. Partly you called it out today as well. To counter that, is there something that you which is in the works that you would be looking at? Because and how much do you believe in the current market that pricing the risk is quite possible for you all? If I can add on to the question, the microfinance industry has also, whether banks and NBFCs, they put forth for some revisions to the norms that came out a couple of years back. Is that under consideration? Would you be open to amending some of the norms there?
I think I would request DG Rajeshwar Rao to take that question.
No, I think there is no real contradiction in the issue which we are highlighting. The lenders are expected to price the true risk of exposures, and interest rates cannot be disproportionate to the risks. The higher credit losses which you are referring to possibly reflects poorer underwriting standards, and that's exactly the message we have been giving, that the underwriting standards have to be strengthened so that the risk is properly priced. If that happens, then there is no real contradiction and the borrowers will get the rates which are more appropriate. As regards the feedback on the MFI guidelines, we are getting feedback. We will review at an appropriate time and see if any revision is warranted at that juncture.
Thank you, sir. अब मैं जी बिजनेस से श्री ब्रजेश कुमार को आमंत्रित करूंगा अपना प्रश्न पूछने के लिए.
थैंक यू सर. सर, आपने एनबीएफसीज के बारे में बात की कि ग्रोथ एट एनी कॉस्ट, लेकिन हाल में कुछ ऐसे इंसिडेंट्स हुए हैं जहां पे बैंक स्टाफर्स को सुसाइड करना पड़ा. एटलीस्ट दे क्लेम कि उन्होंने सुसाइड किया इस वजह से क्योंकि उन्हें बहुत सारे टारगेट दिए जा रहे थे जो मीटअप नहीं कर पा रहे थे. तो आपने एनबीएफसी पर तो बात कही, लेकिन बैंक वाले पार्ट पर भी क्या आपको ऐसे इनपुट्स हैं या आप कुछ सोचेंगे इस बारे में?
देखिए, मैंने भी देखा न्यूज़पेपर में जो इंसिडेंट, 1-2 इंसिडेंट्स जो है उसके बारे में हम लोगों ने भी न्यूज़पेपर में देखा है. और हमारा सुपरविज़न जो है वो बहुत इफ़ेक्टिवली और बहुत डीप सुपरविज़न वी आर डूइंग, एंड वी आर एंगेज्ड विद द बैंक. 2 या 3 इंसिडेंट के ऊपर हम बिल्कुल जनरलाइज करने के लिए सिस्टम के लिए जनरलाइज करना ठीक नहीं होगा. जो 1-2 इंसिडेंट हुआ है उसमें क्या फैक्ट्स थे वो इन्वेस्टिगेटिव एजेंसीज जो है वो उसका जो है वो इन्वेस्टिगेट कर रहे हैं, वो नतीजा उसमें निकलेगा. लेकिन 2 या 3 केसेस में आप जनरलाइज नहीं करना चाहिए. और उसके साथ साथ मैं ये भी कहना चाहता हूँ कि हम बिल्कुल जो फेयर प्रैक्टिसेस कोड है, रिजर्व बैंक का जो फेयर प्रैक्टिसेस कोड है, जिसको कि ना केवल एनबीएफसी बट बैंक्स दोनों को फॉलो करना चाहिए, वो किस हद तक फॉलो कर रहे हैं, इंडिविजुअल एंटिटीज़ या नहीं कर रहे हैं, उसको हम रेगुलरली मॉनिटर करते हैं. और जहाँ जहाँ हमको कुछ कमियाँ दिखता है, हम वो जो रेगुलेटेड एंटिटी है, बैंक हो या एनबीएफसी हो, उनके साथ टेकअप करते हैं. और पास्ट में अगर देखेंगे हमने कई सारे एक्शन भी लिया हुआ है, इंक्लूडिंग मॉनेटरी पेनल्टी लगाया है, और उसके साथ साथ कई केसेस में बिजनेस रिस्ट्रिक्शंस भी हम लोगों ने इंट्रोड्यूस किया है.
धन्यवाद सर. अब मैं नाउ आई आस्क सिद्धार्थ उपासनी फ्रॉम इन्फॉर्मिस्ट.
Thank you, sir. Afternoon, Governor. A fall in global crude oil prices was really helpful for bringing down inflation post 2014 when the framework was adopted. In the MPR, I think you have reduced the assumption for crude oil from 85 to 80 for the second half of the year. But has it become now, in these circumstances, in these new global dynamics, whatever, has it now become more difficult to rely on crude oil prices to bring down inflation domestically? And has it become a lower, smaller consideration in interest rate decisions? And just the second one regarding the MPC external members, you're part of the selection committee. Was there any conscious effort from the selection committee to look beyond experts in macroeconomics, inflation, interest rates, and monetary policy? Thank you.
No, I cannot comment, or I would not like to, mention about the deliberations of the Monetary Policy Committee. These are internal deliberations of the committee. It would not be appropriate, it will not be proper for me to, to comment on the internal deliberations of the Monetary Policy Committee. And the recommendations of the committee go to the ACC for approval, so it won't be appropriate. So I will not comment on that. With regard to the first part of your question, I would request Deputy Governor Patra to take that.
Okay, thank you, Governor. So if you've noticed in this current period, the oil price went to 70 on a certain day, and now it has come down to 80. And you rightly observed that we have changed our assumption regarding crude oil in the MPR. But if you look at a more medium-term perspective, you'll see that the outlook for crude oil prices is actually softer than it is today. And the reasons are that, one, OPEC Plus is planning to restore production cuts in a phased manner through 2025. Then the International Energy Agency estimates that the demand for crude oil is actually softer than it is now. The third thing is that increasingly renewables are gaining a greater share in electricity generation and power and all that. So all these factors make out for a softer outlook on crude oil.
Thank you, sir. Mr. Mayur Shetty from Times of India, you have a question, please.
Governor, last year when you paused the rate hikes, you had made it very clear that that's a pause and not a pivot. This time you're leaving it open. You're saying that you're not commenting on whether it's a pivot. But at the same time, there is the stance has changed to neutral. So how do we see this? Is this a baby step towards easing, or is this completely independent from rate action?
No, you see, today we are in a position, I think I replied that I said that in reply to another question from Monojit. Now, the growth and inflation, in fact, I have said it in first part of my statement also, that the fact that growth inflation are well poised goes a long way to show that monetary policy framework, the FIT framework, flexible inflation targeting framework, is working and has proved its mettle. Now, in such circumstances, when both inflation and growth are well balanced, there was no point in continuing with, there was no justification to continue with withdrawal of accommodation. We have achieved what we wanted to achieve. Now the future path is full of uncertainties, which I have listed out, and these uncertainties and the risks cannot be underestimated. And while we have, again I am repeating myself, that we have given the projections, while we have greater confidence that inflation is moderating, but considering the significant risks that lie ahead of us and which are staring at us, it will be inappropriate, it will not be appropriate to specifically sort of talk in terms of timing of a rate cut. We have to be very careful about opening the gate of the stable. Thank you.
Thank you, sir. Next, I'll ask Mr. Ankur Mishra from ET Now.
Thank you, sir. Sir, last few policies, there were warnings on banks too. This time you have given warning to NBFCs regarding the specific cases which you may have observed. I want to understand that with the actions which were taken by Reserve Bank of India and also the warnings which were given, has the desired result been achieved so that this time there is no mention of bank? And overall also, what is your assessment that yielded results have been found by the regulator, which was warned by you earlier? And also, sir, another thing, don't please consider as a question, what is the reason you have changed the animal from elephant to horse this time?
The reason for shifting from, it's not a shift. The reason for, earlier I used elephant, this time I am using horse. The reason is that it's a war against inflation. And in a war, elephants and horses are used historically. Thank you. I think DG Swaminathan can take the main question.
Yeah. So, thank you, Governor.
No, Arjuna will come when there is a requirement. Arjuna, with his Brahmastra, or with Narayanastra, or the various astras that Arjuna has, will come back if and when necessary. But at the moment, we remain unambiguously focused. I have said that. But on a serious note, I think DG Swaminathan, please.
Yeah, thank you, Governor. See, as regards any regulatory or supervisory action is expected to have the intended impact, and as we have seen in the past as well, that the institutions do respond to the messaging that we do. So that way, whatever steps that we have taken, whether it is regulatory, prudential or proactive measures or supervisory actions that we had initiated, all of them had a good effect and also a demonstrative effect in terms of the rest of the industry also falling in line with the regulatory guidelines. So we have no doubt on that effort. But that doesn't mean that we can be complacent. So we continue to remain watchful, and we, through both our on-site examinations as well as off-site data analytics, we keep watching the behavior of various institutions through various segmental actions. We will take steps that are as may be necessary. And in each of the speech, a certain theme is given, focus is given for aspects that are considered relevant for that month. So at certain point, we were messaging to the banks, and today, because these are 2-3 items that were more relevant to NBFC, it was highlighted. But if you have observed it closely, the closing of that paragraph was covering all institutions, not just NBFCs. So